Why Mark Sobel is dead wrong about gold, an analysis of the article. Today, I'd like to analyze an article that appeared recently, which, in my opinion, is a prime example of how the financial establishment is starting to feel the ground burning beneath its feet. The article, written by Mark Sobel, a veteran of U.S. financial policy who worked, among other places, at the U.S. Treasury Department, is titled "Financial Authorities Should Responsibly Sell Their Gold Stocks." In my view, it's a panicked attempt to reverse a trend that's becoming increasingly dangerous for the American financial system. Next, why now? Before diving into Sobel's arguments, we need to understand the context. Gold prices have risen by about 25% this year. The European Central Bank reports that the yellow metal has surpassed the euro as the second largest component of reserve assets. Studies show that 95% of central banks expect to increase their gold reserves over the next 12 months. Why is this happening? Sobel himself lists the key reasons: concerns about U.S. financial sanctions, geopolitical unrest, reckless U.S. fiscal policy, and the unpredictability of President Donald Trump's tariff policies. These are serious factors that genuinely influence the decisions of central banks worldwide. Sobel's main thesis, and why it's wrong. Sobel argues that central banks should sell their gold reserves to reduce public debt. His reasoning goes, since the U.S., Germany, Italy, and France collectively hold 16,000 metric tons of gold, while annual gold demand is around 5,000 tons, these reserves are being kept off the market, artificially supporting prices. The first problem with this reasoning? You could say the same about any asset. What would happen if everyone suddenly started selling U.S. treasuries? If all central banks dumped their U.S. bonds, prices would collapse too. This isn't an argument against gold, it's basic supply and demand economics. Sobel writes, gold prices receive massive support simply because huge official reserves are kept off the market. That's like saying Apple stock is expensive because Warren Buffett isn't selling his shares. Every asset is expensive when it's bought and cheap when sold. This doesn't disqualify gold as a reserve. It shows it's desirable. Moreover, Sobel ignores the fundamental difference between gold and other assets. Gold cannot go bankrupt, cannot be printed indefinitely, and doesn't depend on the credibility of any government or institution. In times when the U.S. credit rating has been downgraded, public debt is growing at an unsustainable rate, and the dollar is being weaponized as a tool of sanctions, these qualities become invaluable. Math that doesn't add up. Sobel admits that selling U.S. gold could generate about $850 billion, which, against a $30 trillion public debt, is a mere fraction of the problem. For France and Italy, reducing debt by 5% wouldn't solve their structural fiscal issues either. Where's the solid foundation for this proposal? Sobel suggests selling a strategic asset to patch a hole that will quickly grow again. It's like selling an insurance policy to pay for a vacation. It might provide temporary relief but doesn't address the underlying issue. Geopolitical reality. Sobel downplays the most critical aspect of the current situation: geopolitics. Countries are buying gold not on a whim, but because the U.S. has weaponized the dollar. Seizing Russian assets after the invasion of Ukraine may have been, or not, morally justified, but it had consequences. It showed the world that the American financial system can be used as a weapon. Imagine a country suddenly starts selling its gold reserves. The first question others ask is, what do they know that we don't? Selling gold could be perceived as a signal of financial or political trouble. In the current geopolitical climate, that's the last thing a responsible central bank would want to do. The environmental argument Sobel doesn't know. Interestingly, Sobel completely overlooks another aspect. In 2024, the Bundesbank studied the carbon footprint of various assets and reached a fascinating conclusion. Gold is a relatively clean asset because, once mined, it can sit for decades without generating additional emissions. This is entirely different from traditional financial instruments, which require constant upkeep, IT infrastructure, clearing and settlement systems, regulations. Gold just sits. In the context of growing ESG requirements, this could be an additional argument for, not against, holding gold reserves. Who would really benefit? Sobel mentions that gold mining companies would lobby against significant official gold sales, but he doesn't mention who would benefit. The answer is obvious: the American financial system, which is currently losing its hegemony. The dollar is being used as a weapon, the U.S. credit rating is falling, and debt is growing at an unsustainable pace. In this context, any trend away from the dollar and U.S. bonds is a threat to the system. Gold, as an alternative, becomes particularly dangerous. Sobel mentions the 1999 Washington Agreement on gold, but doesn't explain the context. That agreement was necessary precisely because uncoordinated gold sales, notably by the UK under Gordon Brown, caused market chaos. This isn't an argument for selling. It's a warning about its consequences. Moreover, those sales took place in a completely different geopolitical context. The Cold War was over, financial systems seemed stable, and inflation was under control. Today, we face the war in Ukraine, rising tensions with China, resurgent inflation, and debt at historic levels. The real problem with gold from the financial establishment's perspective isn't what Sobel describes. The problem is that gold challenges the entire debt-based financial system and unlimited money printing. When central banks buy gold, they signal to the world that they don't fully trust the system they helped create. That's the real threat, not to the economy, but to the hegemony of the dollar and the American financial system. The psychology of the arguments. Let's consider the psychological side of Sobel's arguments. Brilliant economists and financial policymakers have spent decades building complex systems, theories, and derivatives. They've written thousands of pages on modern finance, won awards, and built monuments to their expertise. And now, in times of crisis, people are returning to a metal used by barbarians thousands of years ago. That must be frustrating for those who've dedicated their lives to convincing the world they have better solutions. Excess liquidity and alternatives. Sobel argues that gold doesn't generate interest and doesn't support the economy. But we live in a world of excess financial liquidity, where cheap money fuels speculative bubbles in cryptocurrencies, startups, and stock markets. Maybe the problem isn't that gold doesn't generate interest, but that the financial system generates too much of it? Moreover, the argument about the lack of interest loses weight when real interest rates are negative or very low. If inflation is 4% and bonds yield 2%, productive instrument actually generates a loss. Conclusions. Mark Sobel's article is a perfect example of how the financial establishment is starting to feel the heat. The author himself lists all the serious reasons why central banks are buying gold: sanctions, geopolitical uncertainty, fiscal problems, and loss of trust in the system. Then he proposes a solution that doesn't address these problems at all, but would weaken the alternative to the American financial system. This isn't a coincidence. It's a desperate attempt to defend the old order. The truth is, gold isn't coming back into favor on a whim. It's returning because the financial system, in its current form, is failing. People see cracks in the foundation and are looking for alternatives. Gold, with all its flaws, lack of interest, storage costs, lower liquidity, offers something no financial instrument can: complete independence from the political and monetary system. Sobel writes about houses built on sand, but the real castles on sand are fiat currencies that can be printed endlessly and financial systems based on debt that will never be repaid. Gold may not be perfect, but at least it can't go bankrupt overnight.